I think that the corporate history between Volkswagen and Porsche is one of the most interesting corporate histories there is, and for many reasons, but chiefly because it's one of those situations where the hunter becomes the hunted. But first, a fun fact. If you ask a random subset of people what their preferred German car brand is, there's a high chance you'd hear a lot of Mercedes, BMWs, and Audis. Maybe not a lot of Volkswagens. But what if I told you that Volkswagen does own Audi, Porsche, and Bentley, and Bugatti, and Lamborghini, and a number of other luxury brands? Anyway, back to Volkswagen and Porsche. So in 2005, Porsche began trying to acquire Volkswagen. In fact, as of 2008, they had taken loans estimated to be about 10 billion euros and secretly acquired 51% stake in Volkswagen. They hit this move by using complex financial derivatives instead of outrightly buying the shares so that they wouldn't have to disclose their interest until it was too late. Eventually, in 2008, they publicly declared interest in buying Volkswagen. That was a law that was required. Once you have 51% ownership in a company, you have to publicly declare. And so they publicly declared in 2008 that they were interested in buying Volkswagen and increasing their share in the company to 75%. However, there was a problem. Volkswagen has always been a favorite of the Germans, and the German government passed a law in 1960, a unique law called the Volkswagen Act. And essentially, this act it protects Volkswagen from hostile takeovers and ensures that it would always be German owned. One of the key provisions of this act was that irrespective of the number of shares that a private owner has in Volkswagen, they cannot have more than 20% voting power. Okay, quick finance lesson here. So in finance and law, there's kind of a separation between ownership and voting power, or control, as we call it in accounting or finance. Essentially, you would expect that when you acquire, say, 20% ownership in a company, you should automatically have 20% control or 20% voting power. However, this is not always the case. And the law provides that there's the possibility that someone would have a high amount of control and a low ownership, or vice versa. You can also find situations where someone has a lot of ownership but lower control. Anyway, this is what the Volkswagen Act provided for, ensuring that even though Porsche had 51% ownership of Volkswagen, they only had 20%. Their plan was to influence the German government to change that law so that they could institute, a legal takeover of the company. But that did not happen on time, although it eventually happened, and that law has now been adjusted. While Porsche were going about trying to influence the government to have this law adjusted, guess what happened? The financial crisis of 2008. And remember, I had said earlier that in order to buy this 51% stake in Volkswagen, Porsche had acquired loans of about 10 billion euros. Well, once the market crashed, they could no longer service these loans, and the payback clause on those loans were triggered, making them immediately payable. This meant that Porsche was in financial crisis. Guess who came to the rescue? Volkswagen. They immediately began acquiring shares in Porsche, and by the end of 2012, they had fully acquired Porsche. But this is the interesting part, and you might have already asked the question, how did Volkswagen finance the acquisition? Well, kind of with free money, or should I say with Porsche's own money. So this is what happened. Before the market crashed, Porsche had successfully acquired 74% ownership of Volkswagen. And at that point, they were legally required to announce. And immediately they announced their 74% ownership and the intent to fully acquire the firm, it triggered something called a short squeeze, which is a bit of a financial jargon. But essentially, the end result was that the shares of Volkswagen rose so rapidly in price that for a very short period, Volkswagen was the most valuable company in the world. That meant that when the 2008 financial crisis kicked in, Volkswagen were literally sitting on a pile of cash. And trust me, that pile was big. Also, because Porsche was in the financial mess, when the stock market crashed, it meant that their stocks were trading very cheaply, and Volkswagen were able to acquire a lot of those stock, for just a little amount of money. So essentially, free money. Now, the big question is, would Volkswagen have tried to still acquire Porsche if they hadn't tried to acquire them earlier? I guess we'd never know. But one can also argue that Porsche wouldn't have been in such a financial dilemma if they hadn't acquired, those 10 billion euros in loans to try to buy out Volkswagen. I'm sure they learned a very difficult lesson in looking before leaping. As you can now tell, Volkswagen is actually a very smart company, and they have successfully pulled off some of the craziest acquisition strategies and moves in corporate history. Maybe in another episode, I'll review, the acquisition strategy for some of the other brands under their label. But for tonight, let's go back to my initial question. And this time around, I'm asking you, what is your preferred German car brand? For me, I would say Volkswagen is a top contender. Okay, enough said. See you on another episode and stay curious.